S&P 500 futures are currently digesting heavy chop near 7,450 to 7,460. Nasdaq 100 futures are entirely flat, and Dow futures are pinned just below parity. The opening bell hasn't rung, but capital is essentially paralyzed this morning. It is Wednesday, July 29, 2026. The primary macroeconomic catalyst anchoring everything today is the Federal Reserve FOMC meeting concluding at 2 p.m., colliding directly with an overnight geopolitical spike in crude oil. The mission of this desk transmission is to decode the institutional strategy briefing and show you exactly where smart money is positioning right now.
The overarching sentiment across the desk this morning is absolute defensive paralysis. The market is locked in a highly cautious, neutral holding pattern.
Capital is effectively frozen.
Right, because risk models simply cannot price in the sheer volume of binary events scheduled for the next 12 hours.
We have to start with the macro pressure cooker before looking at a single ticker symbol. The terminal rate is universally expected to remain on hold at 3.50% to 3.75%. That decision is followed immediately by Fed Chair Kevin Warsh's press conference.
But the geopolitical landscape completely mutated overnight.
Yeah, we had military escalations between the U.S. and Iran. That pushed WTI crude oil up over 3.5%, crossing $82 a barrel. The immediate structural risk here is that energy inflation fears are instantly priced back into the equation.
The timing of that crude spike creates a localized nightmare for the Federal Reserve. Fed Chair Warsh is stepping to the podium to discuss monetary policy at the exact moment a geopolitical shock is driving up the baseline cost of global energy.
And their primary mandate is price stability.
Exactly. Crude oil filtering into transportation, manufacturing, and raw material costs directly threatens that mandate.
But look at the options flow and the underlying assumption retail investors have been carrying all week. They actively want hints of future rate cuts. With WTI pushing past $82, doesn't this entirely box Warsh in?
It does.
If he signals an easing cycle while energy costs are actively accelerating, he risks a 1970s-style secondary inflation spike.
That is the structural reality the bond market is aggressively pricing in this morning. His hands are tied. The transmission implies Warsh is forced to maintain a hawkish posture.
Keeping rates higher for longer.
Right, simply because the geopolitical supply-side risks are too volatile to ignore. Any dovish pivot today would instantly devalue the dollar and send crude even higher. It creates a self-defeating feedback loop.
The bond market is enforcing those inflation fears right now. The briefing outlines immediate, measurable pressure in both the fixed income and currency markets. The 10-year Treasury yield is hovering at highly elevated levels, specifically pinned around 4.61% to 4.62%.
Yeah.
Concurrently, the U.S. dollar index, the DXY, is trading near a one-month high of 101.30 to 101.36. The strategy desk explicitly labels both of these metrics as a persistent macro headwind specifically targeting mega-cap tech.
The real risk here is the mathematical gravity of that 4.62% yield.
I see the 10-year pushing 4.62%, which is obviously triggering multiple compression across the board. But why is the briefing treating this specific yield level as an absolute ceiling for tech valuations? These underlying companies are still growing top-line revenue.
It comes down to how institutional risk models calculate equity risk premiums. A fast-growing tech stock's valuation is heavily reliant on terminal value.
The cash flow is expected 5, 10, 15 years out.
Right. To price those future dollars in today's terms, analysts discount them against the risk-free rate, which is the 10-year Treasury. When the baseline cost of capital breaches 4.60%, the mathematical present value of those future tech cash flows severely contracts.
The market is unwilling to pay a 40 times earnings multiple for future growth when they can lock in nearly 5% risk-free today.
Exactly. Tech valuations simply cannot expand under this discount rate pressure unless the companies deliver massive, unmodeled earnings beats that mathematically overpower the higher cost of capital.
That addresses the multiple compression on the yield side. Let's look at the currency drag from the DXY sitting above 101.30. When we look at mega-cap tech, these are global monopolies. A massive percentage of the revenue is generated overseas in euros, yen, or pounds.
The translation effect is brutal. When a company reports earnings, they must convert all that foreign revenue back into U.S. dollars.
And with the DXY at a one-month high of 101.30, the dollar is incredibly strong relative to those foreign currencies.
The mechanical result is that the overseas revenue is worth less upon conversion. It acts as an invisible tax on profit margins.
So these mega caps are facing a synchronized attack.
Yeah.
The 4.62% yield is mathematically suppressing their future valuation multiples, and the 101 DXY is actively cannibalizing their current quarter earnings per share.
The desk transmission shows exactly how institutional capital is reacting to that synchronized attack. We are seeing aggressive sector rotation.
Capital isn't just moving to the sidelines into cash.
No, it is rapidly rotating out of pure-play AI semiconductors and software. The flow is moving directly into industrials, cyclicals, and healthcare. Market breadth is expanding outside of tech.
The rotation is a direct response to the yield curve. When discount rates are this high, institutions demand short-duration assets. They require tangible, immediate return on investment.
Right. The tolerance for funding theoretical software development cycles that might pay off in 2030 drops to zero.
We see that thesis playing out in the pre-market gappers. Let's pull the data on Ford Motor Company, ticker F. The stock is up over 4% pre-market. The catalyst is a Q2 earnings beat reporting an adjusted EPS of 42 cents versus the street's 35-cent estimate.
And they raised their full-year adjusted EBIT guidance to a massive $10 to $11 billion.
The desk outlines strict technicals here. Ford needs to hold the 15.20 to 15.50 bull level to sustain this breakout. If the underlying bid falls below 14.68, the momentum is dead and the gap fills.
Look at the underlying mechanism of that Ford earnings report. Upward EBIT revisions of that magnitude in a high-rate environment signal internal capital generation.
Ford doesn't need to borrow expensive capital at current rates to fund its operations.
Exactly. It is generating billions in high-margin cash flow right now through physical, tangible goods.
IQVIA Holdings, ticker IQV, provides another clear look at this dynamic. The healthcare and clinical research giant is surging almost 13.9% toward 242.9 this morning.
Yeah.
They delivered an adjusted EPS of 3.15, but the critical data point driving the flow is their record R&D net new bookings of $3.15 billion. The desk notes it must hold 240 to retest 52-week highs.
Those R&D bookings represent binding long-term contracts. Pharmaceutical companies are locking in billions in capital expenditure today.
For an institutional portfolio manager navigating geopolitical risk and a hawkish Fed, a multi-billion-dollar binding contract offers forward-looking certainty.
It is locked-in yield, which stands in stark contrast to the speculative revenues of the AI sector.
But the briefing lists two glaring tech-adjacent exceptions to this rotation out of AI. Teradyne, ticker TER, is surging 13%, and Seagate, ticker STX, is up 6.6%. The catalyst for both is strong, tangible demand and forward revenue forecasts.
Right.
Wait, Teradyne manufactures the physical testing equipment for semiconductors, and Seagate manufactures high-capacity memory storage. Isn't this just the plumbing of the AI infrastructure?
It is.
If institutional money is abandoning pure-play AI, why are they aggressively bidding up the hardware layer?
You have to separate the abstract software layer from the foundational hardware layer. Capital is migrating away from companies promising to monetize AI software applications in the future because those business models are still largely theoretical.
However, data centers currently exist and are actively being built.
Exactly. They require immediate, massive installations of physical memory storage from Seagate. Foundries require immediate deliveries of physical testing equipment from Teradyne to push chips off the assembly line.
The picks and shovels are generating cash today.
The cash is actively changing hands this quarter. Institutions are buying the underlying physical infrastructure because the demand is tangible and immediate, perfectly aligning with the requirement for near-term cash flow.
That hardware demand brings us directly to the ultimate catalyst of the session. The entire artificial intelligence narrative faces a systemic stress test after the closing bell today. Microsoft and Meta report earnings.
Yeah, looking at the pre-market tape, Microsoft, ticker MSFT, is up roughly 1%, near $393.
The strategy desk is laser-focused on one specific metric: Microsoft's $190 billion annual AI capital expenditure. Wall Street is demanding proof that this unprecedented CapEx is actively accelerating Azure cloud growth.
The derivatives market is pricing in absolute chaos for this event. Options implied volatility indicates a massive 6.6% market cap move for Microsoft upon earnings release.
A 6.6% move translates to roughly $190 billion of market capitalization being either created or wiped out overnight.
It's massive.
Let's look at the mechanics of why that CapEx number is so dangerous. It is like building a $190 billion state-of-the-art toll road. Institutional investors do not care how much you spent on the asphalt and the toll booths, provided there is a line of cars paying the toll on day one.
But if that road is empty tonight, the accounting mechanics take over. The depreciation schedules are the real threat.
Right.
When you spend $190 billion on AI infrastructure, those assets depreciate over a relatively short cycle of 3 to 5 years. That depreciation hits the income statement every single quarter as a massive expense.
If Azure's top-line revenue growth isn't accelerating fast enough to cover that quarterly depreciation expense, Microsoft's earnings per share will mechanically collapse.
The desk lays out the technical battle lines for this event. The bull case requires clearing $400 post-earnings, which structurally confirms to the market that AI monetization is outpacing depreciation.
And the bear case is a failure to hold the $380 to $381.40 support zone. The briefing explicitly warns that a break below 380 risks triggering a broader systemic tech sell-off down to 349.20.
The structural contagion of a break below 380 cannot be overstated. Microsoft is the bellwether. Every single enterprise software and semiconductor company has anchored its valuation to the premise that Microsoft's AI infrastructure will generate profitable end-user demand.
If the largest player in the space, with the deepest pockets and the widest distribution, fails to make the AI math work on the income statement, institutional risk models will assume the entire sector is overvalued.
A failure here triggers systematic de-risking across the entire Nasdaq.
So we have the Fed at 2 p.m., WTI oil aggressively pushing inflation fears, and a $190 billion AI reckoning after the bell. The operational question for you, the listener, is how to navigate the tape this morning. The strategy desk classifies the current market architecture as a classic liquidity trap.
Volume is heavily compressed.
Right. Institutional capital outright refuses to commit directional liquidity until these binary events pass.
We are seeing index futures trapped in heavily defined algorithmic ranges.
For the S&P 500 futures, the ES, we are digesting chop near 7,450 to 7,460. The hard algorithmic support floor is 7,415, and resistance is capped at 7,515. On the Nasdaq 100 futures, the NQ support sits at 25,200 with resistance at 26,000.
The transmission issues a direct mandate for the morning session. Do not chase early morning breakouts. Expect two-way stop hunts.
Explain the mechanical reality of a stop hunt in a liquidity trap.
It is an engineered liquidity grab by algorithmic market makers. Because volume is entirely hollowed out ahead of the Fed, the order books are exceptionally thin.
It takes significantly less capital for an algorithm to push the price through a key technical floor.
Exactly. Say, driving the ES down to 7,414. By breaking that support, the algorithm triggers a massive cascade of automated retail stop-loss market sell orders.
Which creates a sudden flush of localized liquidity.
Precisely. The institutions use that artificial flush of retail selling as their entry point to buy at a discount, immediately snapping the price back into the previous range.
The breakout was entirely synthetic.
Entirely. Designed purely to shake out weak hands and generate liquidity in a frozen market.
The desk outlines an even larger structural trap for retail capital today, which they define as the pain trade. This setup requires close attention. The briefing projects that if the 10-year yield surges to 4.70% today, retail investors will reflexively step in to buy the dip in high-beta tech stocks.
They are operating on the assumption that a high yield will eventually force a Fed pivot.
But simultaneously, institutional capital is moving quietly into short-term treasuries to collect a roughly 5% risk-free yield.
The disparity between retail behavior and institutional mandates here is massive.
Let's break down the mechanics of this disparity. If institutional capital is migrating to the bond market to safely lock in a 5% yield, intentionally letting tech valuations bleed out through multiple compression, why does retail capital consistently provide the exit liquidity by catching the falling knife?
The retail side is operating on outdated behavioral conditioning from the last decade of zero interest rate policy, where buying every tech dip was instantly rewarded by central bank liquidity.
But institutions are operating on strict mathematical risk parity models.
Right. Pension funds and sovereign wealth funds have mandatory allocation rules. When the risk-free rate hits a certain threshold, like 5%, their models dictate a mandatory rebalancing.
It isn't an emotional decision.
It is entirely algorithmic. The model forces them to sell high-beta equities, which now carry a lower risk-adjusted premium, and reallocate that capital into the safety of government bonds to guarantee a baseline return for their clients.
Retail investors, lacking these structural risk models, attempt to front-run a bounce that isn't coming.
They absorb the institutional selling pressure. They end up buying expensive growth stocks that are actively undergoing a systemic valuation derating.
That is the essence of the pain trade. Retail bleeds out slowly in multiple compression, while institutions safely warehouse their capital in short-term paper, waiting for the macro environment to physically reset.
Ex
Let's aggregate the data and synthesize the session. We are navigating a massive synchronized collision course. We are tracking a hawkish Federal Reserve watch at 2 p.m. with Kevin Warsh severely restricted by a geopolitical surge in $82 WTI crude.
Yeah.
We're watching institutional capital actively liquidate abstract software positions to rotate into the tangible, high-margin safety of cyclical companies like Ford and healthcare giants like IQVIA. And looming over the entire structural framework of the market is Microsoft's $190 billion CapEx test after the closing bell.
The architecture of the market today is profoundly fragile.
Whether you are actively trading the ES futures ranges we outlined, managing order flow, or simply tracking how these macro mechanics dictate the value of a tech-heavy portfolio, you have to align with the institutional data.
Yeah.
Recognizing the mechanics of multiple compression and algorithmic stop hunts is the only way to avoid becoming the liquidity for the pain trade.
The data leaves us with one critical structural question to monitor into the close. We have established that institutional capital is already defensively locking up 5% risk-free yields, preparing for sticky inflation driven by the geopolitical oil shock.
Right.
If the smart money is already safely warehoused in cash and bonds, what happens to the floor of this market if Microsoft fails to justify its AI spending tonight? If the undisputed bellwether breaks technical support and the institutions are already positioned defensively and refuse to catch it, how deep is the vacuum below 380?
That is the multi-billion-dollar question that will dictate the flow until the closing bell rings. Keep an eye on those resistance levels.